Well, yesterday's video talking about how auto credit is now easier to attain month over month didn't exactly age very well with this whole Silicon Valley Bank situation. So we're going to talk about this and what this means for the car world. But before we get into this video, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So I want to start off by saying that I am by no means a financial expert. I am a car enthusiast, and being a car enthusiast means that I have to be very concerned about what happens in the financial world because, well, cars cost money, especially modern cars. They're very expensive. And so when something happens in the banking industry, like, I'm going to read about it, right? And this Silicon Valley Bank situation, I think, is going to have some pretty major impacts on the car world, but let's just quickly give a synopsis of the situation. Now, there are a bunch of articles and YouTube videos already up talking about this situation, and they're going to be a little bit more educational than this video, I guess, on the situation because, again, I'm not an expert in this realm, but here's my uneducated, I guess, synopsis of what it looks like has happened. So you've got Silicon Valley Bank. They've been around for like 40 years, and they focus on venture capital and tech companies, right? And so it's a very niche market. And well, that niche market was doing amazing at the beginning of the pandemic, but at the tail end, right, especially, through 2022, that world decided to not do as well. And so you had all these tech companies that were injecting a bunch of cash into Silicon Valley Bank over the course of, well, the last couple of decades, and then especially over the course of the pandemic. And then all of a sudden things got hard, so then they started pulling money out. And, that would have been all fine and dandy if Silicon Valley Bank had been smart with the funds, but apparently they weren't smart with the funds. I guess that they decided to buy a bunch of bonds when they were at a really low percentage rate, like just over 1%, because they assumed that the Federal Reserve was not actually going to raise interest rates. Well, that was definitely a dumb decision. And well, once the Federal Reserve raised interest rates, then all of this money, I think it was like $90 billion that they had invested in these bonds, became worth substantially less. And so they basically lost a bunch of customer funds. And so it was kind of like basically a two-pronged attack on Silicon Valley Bank because they had their customers pulling out money because their businesses weren't doing as well, because again, venture capital and tech companies, they're just not doing all that well right now. And on top of that, right, then they have this huge loss because they invested the money in the wrong place, and so it was just too much, right? And the bank basically collapsed. Like, the government came in and they said, yep, this is not going to happen. And the craziest part about this story is that it's like 97% of the funds that were in with Silicon Valley Bank are not insured by the government because most of the accounts were over that $250,000 limit. If you don't know, the federal government will reimburse customers up to $250,000 if something happens like this situation. And well, when you have these huge tech companies that probably have, millions at the lowest, probably tens of millions, hundreds of millions, in accounts, then yeah, like, that's not going to be insured. And so it really was a perfect storm that caused the collapse of the lending institution and will, what it sounds like, potentially cause the collapse of several companies because now they don't have access to their capital anymore. So you have like tech companies that won't be able to meet payroll in the coming weeks. And, if the situation obviously escalates to a certain point, I'm sure that Uncle Sam will step in. I mean, again, uneducated, I don't know what's going to happen. We'll see what happens, but it's basically a big poop storm right now and everyone's talking about it. But what the heck does this have to do with the car world? Well, in yesterday's video, I talked about how auto credit month over month was a little bit easier to get. Like, it was easier to get an auto loan in February than it was in January. However, year over year, it's actually more difficult to get auto credit, and it's for a number of reasons. First off, if you look at the used car market, right, prices have slid by a massive amount. This terrifies lending institutions. And so they're being a little bit more weary about giving used car loans out. And then on top of that, we have higher interest rates, which have also made lending institutions wary because, well, if a person is given a higher interest rate, that means that they're going to owe more on that car because they're paying more in interest on the vehicle, which means that they're going to be more upside down in their auto loan. And so if that person decides to not pay their loan and the bank is left with the car, well, they're going to be left with a loan amount on a vehicle that is going to be more upside down down than what they experienced over the course of, pretty much the entire pandemic, which means they're going to lose more money. And so you can see there's a lot of reasons already as to why these lending institutions are tightening. And then, I didn't have to get into it too much, but like you've got the whole repo situation, right? Repos are increasing. The repo rate right now is at I think 6% or something like that. Like it's higher than it was over the course of the entire pandemic. And it's getting to the point where it's going to, basically hit historical highs. And so we already have this perfect storm coalescing to where lending institutions are afraid to give out, auto loans. And now we can combine this with the whole Silicon Valley Bank situation, and it kind of creates a perfect storm to where lending institutions are going to become extremely strict with who they loan out to because, and again, this is my uneducated opinion, I'm going to mention that, I think that this situation is going to cause a lot of people to freak out. And, some of it, frankly, it could be justified. I don't know. Again, I'm not an expert in this realm. It could be justified. And freaking out will look like people pulling money out of their banks, right? And if you have enough people pull money out of banks, then that means that these banks will have less capital to invest. And so then they're obviously going to be a lot more choosy with where they invest that capital. And so this whole situation could basically cause a huge pullback. We're already seeing a pullback, but like a much larger pullback with the lending that we are seeing on auto loans. And so, month over month, we saw a pretty big increase in auto loans with subprime credit. That could completely be wiped away now with this situation, because if a lending institution basically has their pool of capital decreased by a massive amount because you have a bunch of people running to the bank, pulling their money out, then the last thing that they're going to want to do is give out an auto loan to someone who doesn't have great credit. They're going to be like, nope, we don't want that. We've already lost enough money. We're not going to lose more money. And instead, they're going to focus on the prime buyers, right? The people that have the credit scores of like 760 plus. And so that will then have even greater effects on the market. And so how this could play out is we could basically see a lot of downward pressure on the car market, especially the new car market. The new car market is already trending downwards because affordability is just not there. If you pair affordability with a lack of credit, that's like the perfect storm to just decimate new car sales. Because, well, if you look at new car sales, 85% of those sales are with people that end up financing. And if you make it so it's harder to get access to financing, then these people are just, they're not going to be able to buy a new car anymore. And so they're going to be pushed to buy something else. And so then this could actually put some upward pressure within the used car market, or it could just basically push the used car market to keep doing what it's doing. And the reason why it could do that is, well, if you have the subprime buyers get kicked out of the market, and then you have buyers that would normally be new car buyers that are now used car buyers, you basically have a situation where in the used car market, one group of people is just replaced with another. And I definitely see potential for that, because if you look at the cars that subprime buyers purchase, and again, this is anecdotal based on what I saw when I sold to subprime buyers when I was in the car dealership, like a lot of the deals I did were called CRC deals, right? They were with subprime buyers. They typically bought cars that were between like $7,000 to maybe $15,000, sometimes a little bit more expensive. But if it was more expensive, it was almost always a new car with tons of discounts. Think like Dodge Journey. That was like the biggest rebate machine ever. But I mean, if you wanted to get someone done on a vehicle, Dodge Journey. Anyways, I digress. The point that I'm trying to make is, well, if you have people pull out of that segment, then right, that would naturally pull back prices. But if you look at cars in today's market that are $7,000 to $15,000, they're super hot, and they'd become even hotter if people can't get a loan on a new car. Instead, the mentality might be like, okay, I can't get a loan on a new car. I'm just going to go and pay cash for a $7,000, $8,000, whatever it may be, just to get me by until things get better. And so again, it's too soon to tell exactly what's going to happen, but that is definitely a scenario that could play out. So pulling everything together, the Silicon Valley Bank situation is potentially going to wreak havoc on the car market, but currently it looks like it's mostly isolated to the tech world. You're going to see the immediate effects of this within the tech world and with crypto projects. I've seen a lot of people post on Instagram where certain crypto projects have just completely been destroyed overnight because, well, they can't get access to the capital because, again, it was with Silicon Valley Bank. And again, you're going to see a similar situation with certain tech companies that can't meet payroll. So that'll be the immediate effect. But the less immediate and longer term effect, and effect that, again, more important is with the car world, because that's what this channel is about, is this could make it so that credit availability is just not as good as it is today, which today it's already worse than what it was last year, and it's worse than what it has been historically over the last decade. And so this naturally could put quite a bit of downward pressure on the car market, especially the new car market. So obviously I'll follow this situation and I'll talk with dealers and see what I can find out if, their respective lending institutions that they work with have tightened things after the situation. And I'll make an update video once I have enough information. But at this point, I want to end this video with saying it's too soon to tell. It's fun to, basically, run mental snares with what could happen, but it's one of those situations where we won't know until we know, and then we'll know. I'll see ya.